Hello everyone, this is Mark, back at it again with another valuation video. So, the next thing on the list is R&D. Now, R&D is very important in identifying companies with this durable competitive advantage, because sometimes this can be an illusion which is bestowed by a patent or technological advancement. If it has a patent, at some point, a patent will expire and the competitive advantage will disappear. And technological advancement is often threatened by newer tech. So it's quite important to avoid companies that do spend very heavily on R&D. The next thing on the list is depreciation, and depreciation is quite important because all machinery and buildings held by a company will eventually wear out, and this is recognized on the income statement as depreciation. Depreciation is a real cost to a business since it will have to be replaced in the future. So let's just say if there's a printing company that purchases a bunch of printing presses for $1 million. And since the IRS won't let the company expense the entire cost the year it was bought, it will depreciate at a rate of $100K a year, since the average lifespan of a printing press is about 10 years. So the buying of the printing press will cause $1 million to come out of cash and $1 million to be added to plant and equipment, and $100K to be added to the accumulated depreciation liability account. The actual $1 million cash outlay for the press will show up in cash flow statement under capital expenditures. It is important to note that this expense is not taken in the same year it was bought, but over a 10-year period in increments. Wall Street finance guys like to do a nice little trick where once the press is bought, they add the $100K cost back into earnings, which means that the cash flow of a business can now support more debt for stuff like leveraged buyouts. And this earnings recalculation is called EBITDA. By using EBITDA, you are ignoring that eventually the printing press will wear out, it will need to be replaced. But now the company is saddled with debt from a leveraged buyout and may not be able to finance a $1 million purchase of a new press. Depreciation is a real expense that should always be included. Do not delude yourself in the short term by thinking the business is earning more than it actually is. So companies with durable competitive advantages tend to have lower depreciation costs as a percentage of gross profit rather than companies that are in highly competitive industries. The next one is interest expense. Let me find that. Interest expense. So interest expense is the entry for the interest paid out during a quarter or a year on the debt the company has on its balance sheet as a liability. While it is possible for a company to be earning more in interest than it is paying out with a bank, most manufacturing and retail businesses will pay out far more in interest than they earn. This is called financial cost, and it is isolated on its own since it is not tied to production or sales process, so it is not operating costs.